We're halfway through September and we've seen so much volatility in the stock market this month, particularly when it comes to tech stocks. We saw huge sell-offs to begin the month, followed by a rebound period. Overall, the tech-heavy NASDAQ has shed 6% this month, and we've seen on 3 occasions drops of 1.5% in the NASDAQ. In this video, we'll discuss the reasons for these sell-offs and what we can expect moving forward. On September 3rd, when I checked my portfolio and saw I was down 4%, I figured, oh no, something must have happened. There must have been a debacle in one of the vaccine trials, or maybe Trump imposed a trade embargo with China. But no, none of this happened, and there was no major news that caused this drastic sell-off in the market. Many experts are speculating that this was due to sell-offs, that the market had overheated and this was correction, and people were just taking in profits. Hey, they were listening to Cramer when he said just a few days prior, hey, you should take something off the table.
You have the hottest hand in the world. When you're up big, you got to take some profits while you still have them.
And in my opinion, this is healthy for the stock market. So many of these tech stocks have become so overvalued. There were so few bargains to find, and some of these valuations have just been crazy. And take a look at this table. This is the highest market cap tech stocks. Look in the column of PE ratio. Now remember, the average PE ratio in the stock market is around 20. How many of these companies do you see at a PE ratio around 20? I mean, this sector was just so overvalued. It needed to come back down to earth. We've seen this sector on fire since the March lows, and especially over the last month of August. Over August, Tesla was up 74%. I mean, Tesla was on fire before August, and then it hit August, and it just keeps going and going. And Apple was up 21%. And take a look at this graph. This is the Spider Tech Market ETF. And this is an ETF that's just seen growth. Like, ETFs are supposed to be more conservative, and this thing has just been skyrocketing. And you can see that this whole sector was due for a pullback. It was just too hot. And there's several reasons why we've seen so much growth in this space over the past 6 months. One of the first reasons being is SoftBank. A SoftBank is a Japanese investment conglomerate. You may have heard of them. They've been in the news recently. Recently they just closed a deal to sell one of their chip-making companies, ARM, to a major player, NVIDIA. Anyways, SoftBank, they have been super bulls on the tech sector. The Financial Times published an article last week. I'll link that down in the description. But it was titled, NASDAQ Whale That Stoked the Tech Market Rally. That's what SoftBank has been. They've been a whale. They've purchased over $4 billion worth of call options in the tech market, giving them over $50 billion of exposure. Stock market veterans and hedge fund managers are calling what SoftBank done is absolutely crazy and saying they've seen nothing like it. This company has taken so much risk in their belief in the growing tech sector. And the article goes on to speculate that SoftBank's position on these tech stocks have helped fuel up the rally that we've seen over the past several months. But it's not only these large institutions like SoftBank that have helped fuel up this tech rally. Also, it's the little guy. It's you and me. The retail investor has had a huge part in this rally, particularly what is now becoming a dirty word. The Robinhood investor has had a major say in this. Now, there has never been this much action in the option market, and partly like platforms like Robinhood that are making it so easily available and bringing options trading to a whole different demographic. Retail level purchase derivatives are at an all-time high. Over the past several months, there's been an average of about $335 million in options trading. That's up 3 to 4 times the averages from 2017 to 2019. And we all know what the Robinhood trader loves to invest in: tech and growth stocks. And so many of these options that have been purchased on Robinhood are short-term contracts that expire like in less than 2 weeks. As opposed to SoftBank, many of their call options have been longer term. And when a call option contract is bought, say for example on Robinhood, that broker will go and buy shares of whatever those options are in to hedge themselves against rising prices. So you have these call options being purchased, saying that essentially I'm betting that the stock's going to go up. And then you have the company going out and purchasing shares. Now you have so much of these call options that the shares are also being purchased, so it's artificially inflating the price. This is why we have seen such huge gains in the tech sector over the past several months. So now that all these prices are high, so many large institutions and hedge fund managers are saying, hey, I need to show my clients something. We need to show that the portfolio has been doing good. Some of these tech stocks are so high right now. Let's take some of this off. And that's what you've seen. You've seen major selling from large institutions taking in profits. And that's why there's been a sudden pullback in prices over the past 2 weeks. So that begs the question, what can we expect to see next? Well, I expect volatility to continue over the next several months and into 2021. But these tech stocks are not untouchable. In fact, I think quite the opposite. When we see these dips, that could be a great time to purchase some of these companies that have been way overvalued. You should get a list ready and know the ones that you've wanted, or maybe there's been positions that you wanted to add to. But it's very important to understand and analyze the valuation of a company before investing. Let's look at 2 examples of 2 companies that have 5x'd since March. We'll look at Square and Zoom. First, Zoom. Now, people talk about the PE ratio, and that's a good measurement of more developed stocks, but I personally don't recommend looking at the PE ratio when looking at more immature growth stocks. I look at sales and what the potential of sales could be, and then what possible margins in that space are. Well, Zoom has been under $100 a share at one point this year, and now it's in the mid-4s, just crazy. So when you take a look at their price to sale ratio, it's 83, which is absolutely crazy. It was over 90 at one point. Zoom has a market cap of $116 billion. That means for that valuation to make sense, I would want to see Zoom in the near future, or have a reasonable expectation in the near future that they could achieve roughly about $24 billion in revenue a year. That's $6 billion in revenue a quarter. And you look at what they're actually doing, last quarter they did $660 million in revenue, which is great. That's a huge growth. But they're nowhere near that $6 billion a quarter mark where I could justify this valuation or even hopes of getting to that $6 billion. I don't see how you can justify that anytime soon. I mean, this is such a growing space. But then you look at what they do. Is it proprietary? No, I think other companies can create this, but they have a brand. But still, they're in a space that can easily disrupt. And if they're not offering fair prices, somebody will undercut them and will be able to take away a portion of their business. That's why I feel a company like this is one that has had massive growth that you should be very careful of. You look at a company like Square, on the other hand, who has seen this rapid growth as well over the past several months. In March, the stock was priced in the 30s, and now it's trading at over 150. But you take a look at the price to sales ratio, it's just a tad bit over 10. I mean, compare that to 90 for Zoom. And Square is in an industry with high barriers to entry and also high margins as well. So today you can justify this price. Maybe there's a little growth priced in there, but still there's still a lot of room to grow. Whereas Zoom, it's automatically pricing in best case scenario. And this is what you need to be careful of. And then you even compare the stock market darling Tesla to a company like Zoom. Tesla has a price to sales ratio of 15. So Tesla has some growth priced into their valuation, but still there's so much more room to grow and exceed that. That's why I think it's so important to understand the valuation of a company. Know in your mind what you think is fair for that company. And know that even if it's a company that you like, but still the valuation has to be there for it to make sense. So make a list of these companies that you think are valued somewhat appropriately. Know these lists. On these days where the market's seeing red and there's huge dips, be ready to pull the trigger on some of those companies. So if you enjoyed this video, please consider subscribing to my channel. It will help my channel grow, and I hope to see you around on the next video. Thank you.